Good afternoon. Last time I decided to proceed differently than the previous times, where I was talking about a particular subject. And I tried to recap some of the issues that we had been dealing with on an example. And the example I chose is that of the company called Enron, which was famous in 2001 for collapsing in a very short period of 46 days. It was supposed to be in very good health, supposed to be number 7 in terms of financial strength in the United States, and within a period of 46 days it disappeared, and provoking a lot of stupor among the employees and the world around. They were surprised of what was going on. I insisted on the fact that 2 theories which were supposed to define the company of the future were actually put to the test in that case and showed that it didn't work. Whether the lessons were drawn properly of what had happened is something to determine. 2 of the innovations which were central to the functioning of the Enron company was the stock options. Stock options had been devised in 1975, and they were very prominent within Enron. 60% of the employees received stock options. And the very devious logic of stock options was shown to be one of the main factors leading to the downfall of the company. That notion had been devised by a consultant group called McKinsey, to which actually the CEO of Enron in the final period, Jeffrey Skilling, worked. And the other notion which the McKinsey had designed was the notion of asset-light company, a company which has very little liabilities in terms of things that would need to sell in case of difficulty. And it showed in that particular case that the fact that they had very little to sell in period of stress was actually not at all an advantage, but a disadvantage, because it precipitated the fall of the company. It was also the first test case for the rating agencies. The rating agencies, that's an old notion, actually comes from the 18th century. But the very modern way they operate in terms of assessing the likelihood that a company may default was put to the test by the very quick collapse of Enron. And there was something that I talked about, which I call the rating cliff, showing that a company doesn't downgrade very smoothly necessarily. When there may be even a situation where some dynamics start between the different rating agencies, precipitating the fall of Enron. Today I'm going to deal with something else. When you work in finance and when you read books, for instance, about derivative financial instruments, these books are very much not a theory, they're rather a kind of catalog. They tell you, well, start at this, you start with a forward rate, then you move from a forward rate to a swap, and then you move to futures and so on, but there's no theory, no approach really linking them. It is a catalog. They tell you, well, what links them is the fact they belong to the same group, the same family of products. They are derived, their price is derived from that of an underlying, which is another product, that product being usually some type of debt, being it shares of a company, stock or shares, being a debt instrument like an obligation, a bond, things of that type. That's usually what is the underlying of a derivative financial instrument. But once this has been said, well, I think that's a bit at the end of the discussion. Then they describe to you in a very detailed manner the way these have been used, the way they function, the type of markets within which they are traded or not, being it over the counter, meaning that it's private deals between people, or there's an organized market, meaning that there's like a stock exchange, or a compensation room, a place where the operations are centralized, to which people come, or they are simple contracts passed between two parties with no necessary information being transmitted to any other party, and in many cases not even to the regulator. So what I tried to do at some point, actually, the anecdote is that I was starting in finance, and I had no training in finance. I had been hired essentially as an engineer, and for my own understanding, I thought, okay, how do you put these together? And I built a kind of portrait of these different instruments, not only the derivatives, but also those which are used as being the underlying of the derivatives. How do they hang together? Can you make an image of it? Can you make a representation where all these things fit in a way or other? And I think the way to do that, and I'll try to illustrate that, is the notion of risk. And once you've actually put all these instruments together, taking that the risk as a binding element in order to show how there are variations of sharing of risk. Once you've done that, I think it's become much easier also to put a kind of ethical perspective. Why is that? Why would that be the case? I think the reason is because either the sharing of the risk is fair, and in that case you will say, well, the instrument is probably ethical in its concept. And if it's not, the sharing of the risk is not properly assigned, or if there's not sufficient compensation for the risk being taken by one party compared to another, I think then you have an issue, and it's easier to look at things in that particular perspective. There's another dimension which is ethical, that is, how much does the fact that you have a contract with another person to deal with these issues, how much does it put other people at risk by you doing so? And I'll give some examples. The starting point, what you should regard, I would think, as the elementary transaction, the elementary financial operation, is a sale. You sell something. There's a property which is yours, and you're going to release that property and on an object, on a service, on something which may be material or immaterial. It may be a patent on some procedure. You can process it. You can use a procedure to produce something. It can be material. It can be an object that you sell. As long as you release property on an object, you can release property on an object without it being a commercial transaction. If it's a pure gift, well, you don't receive anything in return. The person who's received it may decide that a gift from that person next time around is not necessary, and they may sell something that you've given to them for free. But in a sale, property is transmitted, and usually in exchange for some monetary compensation. If we want to reverse the operation, well, then the merchandise, the good, needs to go back to the old owner, and money goes the opposite direction, goes back to the prior buyer. This, I would think, is the elementary transaction that you can do, and it's financial because there's some money being exchanged in the process. As I said, the property has been transmitted once for all, and if the operation needs to be reversed, then property has to be returned to the original owner. There's another type of contract where the possession of the object is disconnected from the property. You will lend something to somebody, the property remains yours, and but the person who receives it can use that object, and usually there's a contract which explains how he can use it or she can use it and not otherwise. And at some defined period in time, usually the object will be returned. The condition attached usually that there's a compensation. There's a compensation for being able to possess an object or a service or something that's been lent. Like using a patent for a particular time and period of time. And the compensation usually is a payment which the value of the payment is most of the time calculated as a proportion, a part of the value of the object which is lent. It's not only a part, but it's also defined based on a period. The payments will depend on how long the property has been transmitted to another person who possesses it for that time. So here we have already a second type of operation, of transaction. This is a loan, and there's a borrower, and there's a lender, and there's an additional, apart from returning what you've been receiving for a while, which may be an amount of money. In that case, you receive some money and you'll go to return that money, so you make a payment at the end, but you're also going to make payments that will be interest payments for having the use of the object during the period. I often use that example of sharecropping as a way to show how historically these things start. And as we know, when we look in the literature, we always find that there's sometimes some examples of things we're talking about here already in Babylon or in ancient Egypt. But if you think of the situation which has been very common in the rural environments, or as well in Europe as in other continents, that example of that type of contract called sharecropping, I think is very much the starting point from which we can then look at things as being the third, let's say the third type of transaction. I've already got a sale, I've got a loan, a borrower and a lender, and now I'm introducing a third notion, which is a contract of sharecropping. In a contract of sharecropping, I've mentioned it before when I talked about formation of prices, and in particular that the Aristotle's model of price formation is very much based on that notion of sharecropping. In a sharecropping relationship, you have, and you'll see immediately how it ties in with a loan. In a sharecropping situation, you have an owner, you have a sharecropper, and the contract between them will be the following. Let's say the landowner has some piece of land that can be used for agriculture, and you have a person, a man or a woman, who is prepared to work on that land and make harvest being produced, a crop being produced. And the agreement is the following. The landowner will receive from the peasant who will use the land, because he has no property of that land, he will receive a share of the crop. And there are different types of contracts, and I already mentioned earlier that according to the power balance between landowners and potential candidates for obtaining these types of contracts, according to the power balance, which may be defined entirely by the competition, the competitive environment. If there's one landowner and 1 million people who are prepared to use his land, of course, the deal will be more favorable to the landowner. If a landowner has some land, and there are very few people who can, if there's a lot of landowners who have land that is not being used, which is fallow, and if there are few candidates for becoming sharecroppers, the power balance will be in favor of the sharecroppers, and the definition of the contract, maybe in some cases 70% for the landowner and 30% for the sharecropper, or reverse, depending on the situation. At the end of the, let's say the example of a harvest of a crop, at the end of the season, a certain amount of grain has been produced, and a part is being given to the landowner. Very easily or quickly, depending on the circumstances, the landowner may say, don't bring grain to me in a cart, just go sell it and give me a part of the money instead of part of the crop. In that case, the money that will be paid will be as defined by the share. If the person goes to the market and sells for 1,000 euros and the contract is 50-50, he will give 500 euros to the landowner. If you compare the amount which is being made every year by the agriculturalist and the amount in money that will be received by the landowner, it's very unlikely, you imagine, that the same amount will be paid every year. There will be an element of variation. The likelihood that the crop is exactly the same from year to year is very, very small. The way the contract is defined, it is unrelated to the actual value, sales value of the land. It has no relationship to that. If it's a 50-50 contract, it's just the value of the crop of what's been produced that will define how much will be paid to the original owner. There's another way of defining the contract where it's not the new wealth created that will define the money will be paid as a share, but it's the value of the piece of land that's being used. If the landowners say, well, you just simply pay me 500 euros a year and that's it, and I'm not concerned about how much you produce on the land, that's called rent. That's not a share, it's rent. It's an amount, it's the same as when you rent an apartment or you rent a house or you rent a car. There's no way the wealth you're creating is actually related to the amount which is required from you. So we have, in a sharecropping situation, we have a proper share, meaning that not the same amount of money will probably be paid every year. Or we have another situation, which is not sharecropping anymore, it's just renting, and then in that case, there's a fixed amount of money that will be paid. So, we already have 4 categories now. We have sale, we have the notion of a loan, and the rent, paying a rent is actually a variety of just a loan, and we have that notion of paying a share, which is paying an amount which is variable every year or every period for something you use, because it is variable, because it is a share of what will be produced with from the capital that's been given. Having said that, I can already just introduce the notion of risk. When I think of a sale, you may say there's some risk involved. For instance, that there's been cheating on what's been sold. Well, we sold a car which was supposedly to have only been driving 2,000 kilometers. You go to the station, and the guy looks and he says, "Well, actually, the guy's been driving 200,000 kilometers." You have a resort. You can go back to the seller, and you have justice on your side. They will say, "Well, there was cheating on the quality of the product." But otherwise, in normal circumstances where there's no complaint, when there's not been any cheating, risk has been the risk attached to the property has been transferred simply by the sales to the buyer. And as soon as you say that, then you think of these asset-backed securities which were backed to subprime loans. And when the guy who was selling that was saying, okay, well, that's it, and that there was no possible recourse against him for having sold it. And that was an issue about the quality of what actually had been sold. If you think of a loan, well, there is a risk for the person who lends. And the risk is very much that what has been lent either will not be returned, or that the interest payments that were promised will not be paid. And so there is a risk associated to lending something to somebody. We all know about the books we've lent, and that many of them have never returned. There is that joke that I can't help mentioning of a British author, Jorion, who said once, I hate people who don't return the books you lend them. The situation has become so bad with me that the only books which are on the shelves of my library are those I've borrowed myself. In the situation before I move to sharecropping, how is that risk of the property not being returned or the interest payments not being paid, how is it dealt with? Well, there is an element of insurance which is introduced within the operation. There is, let's say, on a particular market, there's a standard interest rate which is defined for borrowing a particular type of thing or particular thing. Let's imagine, let's say, the different countries. Let's imagine the Eurozone. Let's imagine the different countries in the Eurozone. There's one country which everybody really, is confident, trusts. It's Germany. And when Germany issues debt, meaning that it goes to the market to borrow, there's a particular interest rate attached to the obligations, to the bonds that Germany issues. And that will be, just to give an example, let's say so for 1 year, Germany borrows for 1 year, and the rate attached is 1.5%. Then you go on the same markets, and you look at Greece, and you look how much Greece is being asked for lending for a year, and you realize it's not 1.5%, it's 6%. The difference between the two is usually called the spread. We say the Greece to Germany spread, and that's a 4.5% difference. Why is there a difference between the two? Well, because the trust that the money will be repaid, that the interest cash flows will be paid. The assessment of the market is there's a risk that will not happen, that the interest will not be paid, and that there will be no proper repayment of the full amount at the end of the period of the bond, of the money having been borrowed. What is that spread? Well, that spread may be a number of elements. I'll just mention first the most obvious. It's a premium risk. People who lend to Greece know that there might be a risk, and they try to include within the interest rate being asked a risk premium, like an insurance premium, just because they will be lending money on other markets. Maybe they will lend money to Cyprus, to Portugal, to Ireland, to other nations which may be in difficulties right now. And they will say, well, maybe they will all survive, maybe one of them will survive, maybe some. But let's ask a serious risk premium for from all of them, and that will be a way for me to getting an insurance, to getting a premium that would, to some extent, cancel the risk that I'm taking. So there is an element of risk management within the interest rates which are demanded from countries which are trying to get money from the markets who are issuing debt on these markets. If you, I said that there's another element, and some other element which was when you take an issue like that of Greece, the risk, of course, another premium, which is not exactly a risk premium in terms of not being able to pay the amount back. It's the, I forget the phrase which was used recently about that, but it is the risk that Greece may leave the Eurozone, and that therefore you will not be paid in euro, but you may be repaid in drachmas if Greece go back to the drachma. It is another element of risk, of course, which is not simply that the money will not be repaid, but that you may be paid with a supposed equivalent in another currency, which might be effectively devalued before compared to the one in which the debt was issued. So, risk premium attached to maybe a risk premium may be part of the interest rate which is demanded for a loan. If you think of sharecropping now, which was my third example, well, risk there is divided exactly in the proportion in which the contract is being labeled. If there's a wonder crop, if suddenly it's been 1 year, it's been that the crop is 3 times as big as usual, it will be very good for the share crop. It will be good for the landowner also, because they will receive a share of that additional crop that's been produced. And how much will they receive? Well, exactly in the way it was defined at the contract. So it's the 50-50. They will benefit equally from having a wonder crop in one particular year. If it's a terrible crop, well, the sharecropper will receive less, and the landowner will receive less too, again, in the same exact proportion as defined in the contract. If I take now rent, the situation of rent, where the owner said, well, I mean, I don't care about what you produce on that land, but just give me 500 euros every year, the risk of loss and the chance of gain are totally disconnected. I mean, are an issue which is totally disconnected from the landowner. He receives the same amount every year. If it's a beautiful crop, he doesn't benefit from it. If it's a terrible one, he's not being damaged from that. There's no detrimental aspect of it, of the situation for him. Therefore, in the case of rent, and if you take the example of that peasant, that agriculturalist, the risk is entirely his. The risk is entirely his. It may even hit a year where the rent he's been asked to pay may be an amount of money which is higher than what he's actually made during that year. And so there will be a situation of duress. That's why I imagine that sharecropping relationship was so common in the older times, where it still exists in activities like coastal fisheries, where the returns might be extremely volatile from year to year. It does exist in other activities like making salt in traditional ways in Europe. It is an activity which depends very much on whether the summer will be dry or not, and a sharecropping relationship seems to be fair in that case. Now, if we move within, so far we've stayed in, I would say, in the world like it is, with everyday transactions. You don't need to be in finance to have heard about sales or borrowing money. If we move now in what we call properly the financial world, we can think of different instruments. Like, let's take now a firm, a company, and the company needs money, and there will be a traditional type of loan. It's less common in Europe to proceed that way, but American corporations issue debt instruments very much in the same way as sovereign states, and a person who lends money in that way, a lender, will be paid an amount of interest, simply called. But there's another relationship for companies, and that's very common in the world. It's it's issuing shares by a company, and these shares, or stocks, the Americans call that stocks, are being bought on the stock market, and you buy them, and the value varies. It should vary logically according to the value of the company as such. But usually a share allows you to receive dividends. You receive it's called also the coupon, and the coupon gives you an amount of money depending on the returns of the company. It's called a share, and it's the exact same situation as with sharecropping. The sharecropping situation I described with a peasant and landowner is actually the template, very much a template for the way that the stock exchange works with shares. And it's no accident, of course, it's the same word being used, because it is the same mechanism. In recent years, some companies have have tried not to give dividends. They've tried to make people benefit only from the value of the share going up. So they tried to get out of that particular logic. And the reason why was essentially because in the United States, in any case, dividends were more taxed than gains on capital. Gains on capital being the difference between the price you paid for a share in the company when you bought it and the price when you sold it. The difference, the benefit you made used to be not taxed as high. Now, in the wake of the downfall of Enron, when it was realized by the American legislature that difference in taxation, fiscal difference, was really an incentive for people to mismanage their company. And if you were there last time, you will have heard how. Because the company, I mean, the executives of the company became totally obsessed with the fact of simply making the value of the share go up. There was an additional incentive, of course, which was the stock options that they were benefiting. So they were benefiting directly from the rise in the value of the share. And I mentioned another thing, which as a company, if a company was issuing a lot of stock options, it could actually manage, like Enron did, not to have to pay any income tax at all. So the operation of the stock exchange is in no way different from the situation of shareholding or simple loans that I've described so far. There's only a little twist that happened, and that's something I would very much like to really investigate. How did it happen, and when did it happen? There's a notion that got introduced at some point that the shareholders are the owners of the company. And that seems very weird if you think of it, because obviously they're just people who are lending money to the company. Why would that derive into the notion that they own? They are very much provider of a resource, but there's no difference in essence, I would say, between a shareholder who buys share of the company and one of the creditors of the company who simply bought some of the debt instruments that the company issued. So that's something I would like to find out when that notion, which doesn't make, I would say, logical or philosophical sense, was introduced. When you look properly into the text, you realize that it is not real property, although it is said that the shareholders are owners of the company. The legal text mentioned a lot of differences between proper ownership and being owner of a share, but still there is a notion there which is present. Now I'm going to the real flesh of the issue, because I'm going to start talking of a proper derivative instrument. One of the first is called interest rate swap. In an interest rate swap situation, you have two parties. These two parties agree that, I'll first start with a somewhat simplified example, because there are traditions within the way that interest rate swaps have been put together, but let's just describe the plain vanilla, as they say in America, a situation of an interest rate swap, meaning that people exchange at the same time, they exchange cash flows. The two parties exchange cash flows. Let's say that for 5 years, which is a typical length for an interest rate swap, people every 6 months will exchange amounts of money. If they were exchanging the same amount, the transaction will have no meaning, of course, that they would exchange the same amount of money, let's say on the 1st of January and the 1st of July. It would make no sense. The initial template for the swap is that people exchange an amount which was the same at the day they concluded the contract, but they exchange it in different currencies. And there again, like a sharecropping situation, the likelihood that they would pay the exact amount is very unlikely because the change rate between two currencies varies according to the markets. Of course, you can have two currencies which are linked to each other. In that case, it would have no meaning to having a currency swap. But let's say the following. Let's say that the change rate for the euro to the dollar, that today it's 1.30, okay, that you have to pay $1.3 dollars for every euro that I give you. And we make a contract today that we're going to deal with an amount of a million euros today, and we have on one side, and we have $1.3 million dollars on the same day. And we exchange that amount of money. And there's no meaning because it's meaningless because it's exactly the same. So we don't do that. But we decided we're going to do the same every 6 months. I'm going to give you €1 million, and you're going to give me $1.3 million. But it happens that in 6 months when we do that, actually the exchange rate between the two has changed. Now it's 1.29 for the $1.29 for a euro. Now it has some meaning because now the one who's going to pay euros will pay an amount which is higher than no, it's the reverse. If the they're going to exchange again 1.3 million against in dollars against 1 million euros. But because the dollar now is 1.29, receiving 1.3 million will be an additional 100,000 euros, $100,000, right?
Just trying to see.
Yes.
Because in an interest rate currency swap,
Yeah, no, I haven't tried to start with it. I'm going to tell you what it is. No. I'm the one. Okay, but I was trying to explain where it started from, and I was trying to start with a simple example. Okay, $1.3 million on the first day, exchanged against 1 million euros, and there's no loss or no gain for anybody. They're going to do that again 6 months later, and because the exchange rate between the two currencies has changed, one of the parties will lose money and the other one will gain money. All right. And they'll do that over the 5 years. Why would people do that? Either because they like to bet, because they think, one of them thinks that the dollar will go up against the euro, and the other one thinks the reverse. Or, in most of the cases, that's the commercial justification. They will have to spend, let's say in dollar, but they receive essentially cash flows which are in euros because they have some deals between different continents and different countries. In the case of an interest rate swap, we're going to decide on one particular day that we're going to exchange interest on a specific amount of money. And that amount of money, because that will never be involved in the transaction, it's called the notional amount. We're going to make all the calculations on $1 million, let's say. And we're going to do the following thing. It's again a situation of that of the same type we described. On the day we decide, we're going to do the following. One will pay floating rate, and the other one will pay fixed rate. And the way that at the inception, at the beginning of the contract, the way that the fixed rate will be defined will be the same as the floating rate on the market. Okay. Markets, the interest rates on the markets, as you may know, they fluctuate from day to day. Why is it? Because the power balance between lenders and borrowers, it varies according to economic circumstances. The central banks have some impact on defining where these rates will be located, and so some rates will be fluctuating. You may have heard of LIBOR, and I spoke about LIBOR. Every day, 16 banks determine what is the level of LIBOR, and it changes from day to day. How do they determine the level of LIBOR? They're being asked, how much do other banks ask from you for lending? So it's very much a reflection, a barometer of the situation on the markets. Let's take LIBOR 3 months, and let's say that LIBOR 3 months is 1.775. We're going to make the following contract. One party will pay every 6 months, will pay 1.75% on that 1 million amount of which has been defined as the amount on which, the notional amount on which the payments will be calculated. One will pay 1.75, and the other one will pay whatever the market or the market rate for LIBOR 3 months will be at that particular day. So we'll be in the same situation as with the more simple exchange rate. We will have one fixed amount, and the other one will be one that fluctuates, that will go up. Sometimes will be higher than the 1.75, sometimes will be lower from the 1.75. But that 1.75 is a reference because that was the rate on the day itself when the contract was concluded, and where it didn't make any sense exchanging because the amounts would have been the same. The situation again, as I said, may be justified because you're being paid fixed rate, but you need to make payments in floating, and so on. If you go back to the sharecropping situation, you will see now that you have very much a parallel between what I said about rent and the sharecropping system. In one case, you pay rent, it's 500 every year. If you have the situation where the landowner was receiving a share on what was being produced, then it would be someday higher than 500, sometimes it would be lower. So if you look at the interest rate swap, you have a situation which is very much like you would have one who receives rent and the other one receives a share, and they would exchange their payment at the periodicity which has been defined. We have, therefore, in that interest rate swap, we have actually a simple extension of what we have been looking at before. Some people are in a situation where risk is not actually shared because the rate has been fixed, and some other are in a situation where risk is being shared, and the amount they receive or they're going to pay is defined by the fluctuations of the market. I've already mentioned the notion of insurance, because I mentioned that premium risk, which is included in the interest rate, which is demanded by somebody who's lent money to somebody else. The notion of risk is particularly clear in the notion of insurance. The risk here is not shared. One party is buying the risk from the other party, and the other party is going to pay a fixed amount of money for being released from the risk. You have the risk of setting your apartment on fire. You're going to move that risk to an insurance company. The insurance company will take the risk of you setting your apartment on fire. In exchange, the company will have made a statistical analysis that we discussed before about the notion of risk, and is going to ask you a premium for that risk. The risk may evolve, that the company may raise or may even diminish the premium that will be required from you. But in any case, the risk has been entirely transmitted from one party to the other. In this case, there's no sharing of risk. It's like in a sale. The risk itself has been entirely shifted to one of the party for a price. For a price it will be paid. If you think now another financial instrument which has become extremely important, which is the option. The option is a type of insurance, if you wish. If you buy a share of Exxon company, you buy it for 25 euros, and it may go up, it may go down. If it goes down, well, you're hit by it. If it goes up, you benefit from it. But you may think the following. You may think, okay, I only want to benefit from the value going up. I want to release the risk of the value going down. So what can you do in order to do that? Because if you buy it simply, you're exposed to both the loss and both the gain. Well, you go to an insurance company and you say, I want to be protected against the risk that the value of the Exxon company goes up. If the value of the company goes up, I'm exposed to a loss, and I would like you, the insurance company, to pay me for that. The insurance company may accept. In that case, you've managed to receive money if the value of the company goes up, because that's the loss you're supposed to be exposed to. But if the value comes down, you're not exposed to anything because you've not insured yourself against that. For the price of receiving the benefit of the value going up, but not being exposed to the loss of the company, value of the company share going down, you pay premium. That seems normal, right? You've released, it's an insurance situation, you've released a risk, all risk to the other company, and you pay for that. Well, that type of insurance, which does not exist, which is a fanciful example I give, that's the operation of an option. That's exactly what an option is. And the option I described there is called a call option, meaning that you benefit from the value going up, but you're not exposed to the value coming down. The opposed elementary option is called a put, and in the put you make money by the value coming down. The contract is reversed. You benefit from the value coming down. Now an instrument that I've already talked about. Now I'm moving to the financial instruments which are central, which have been central to the current crisis. A credit default swap has got an element of insurance in it. Let's say that you have that you've bought that instruments from somebody who issues them. Greece is issued debt, let's say 5-year debt, and you've borrowed it. You bought it, meaning that you've lent money to Greece for 5 years. Now you get very worried about the possibility that you will not be refunded the money at the end, and you look for somebody who can actually insure you against the risk, the loss, the possible potential loss that you may be exposed to. And you find a bank indeed who will say, okay, you can insure against the risk. We will pay you the difference if you lose. We will pay you the amount of the loss that you incur, and you'll simply pay us a premium for that. You will pay a premium. That instrument is called a credit default swap, and the terms are quite clear. It's the notion of a swap. Things are being exchanged, and it's what it's about. It's a credit default, that money is not reimbursed, that it is not refunded. That seems quite straightforward, and there doesn't seem to be any much difference between that and insurance, except as far as the regulator is concerned, because there is a major difference, which is that it's not treated really like an insurance. The insurer the emitter, the issuer of the credit default swap has never been so far required to make the provisions, to make the reserves that would help him to deal with that. The risk he's actually exposed by accepting this. And that brought the downfall on the 17th of September 2008, the fact that that the regulator had a blind eye on what happens in the case of a credit default swap issuer was the cause on the 17th September 2008 of the fall of AIG, the biggest insurance company at the time in the United States. I will say something also about Dexia, because Dexia to some extent was in the same type of business. And Dexia may provide an interesting illustration of what we're dealing with. But there is a difference between an insurance and a credit default swap. I mentioned it before, but in a credit default swap, you may insure yourself against a risk you're not exposed to. And what is that, insuring yourself against a risk you're not exposed to? That's speculating. That's just trying to make money out of a situation which will probably be a bad situation for somebody, which is not you, but you're going to act as if you were exposed to that risk and insure yourself against a non-existing risk, but you will be paid in case the risk materializes for someone else. And that's why that way of using a credit default swap has often been called, in the financial jargon, insuring the neighbor's car. It's as if you were going to an insurance company and you would say, I would like to insure my neighbor's car. I don't own it, but I would like to make money if he has an accident. And of course, as soon as you say that, you see that as what's called moral hazard there. You will be encouraged, for having taken that type of insurance, you will be encouraged to try that something bad happens to the car of your neighbor, because you'll be making money out of it if that happens. He will not know that that's the case. There's been a lot of discussion in the United States about what's called COLI, company-owned life insurance, which is when American companies were taking life insurance on their employees, not telling them, and not telling the family when the person dies that they're making a lot of money out of that. That COLI has been, was at the central of a Michael Moore movie, which was called, I don't remember how it was called. You know who Michael Moore is. He's making these documentaries which are extremely critical of the American system. And a central part of his description of, I think it was called Capitalism, a Love Story. I think that's the way it was called. And that type of financial contract was also called in the United States, it was called the janitor life insurance, meaning that the janitor is the person who cleans the corridors in an American company, and companies would take very high amount life insurance on people, personnel that they don't really care, but they would insure the janitor, the life of the janitor for $1 million and make that money when he dies. It became a scandal, and quite independently of Michael Moore's movie. But when it came to the surface, these COLIs were essentially, especially for why these COLIs were issued by companies, that it was essentially a way to provide the funding for a golden parachute. For the money would be paid for some executives when they leave the company. It would be an easy way for making money. In that way, that would not be taxable, because of course, the benefit of the life insurance was not taxed in the United States, and so people were benefiting from a loophole. Really, that usually the people who have life insurance are people who grieve or are sad when the person dies. In this case, well, the company was happy then the person dies, because it was a way for getting the funds for the golden parachute. That was called a COLI. The credit default swap is, when it's used, as being called a naked position on a credit default swap. It's called naked position where you're not when you're betting on something going wrong, while actually you're not being exposed to it. In the case of the onslaught, the attack on Greece in 2010, it was essentially led on that credit default swap market. A large number of people who had no Greek obligations in their portfolio took naked positions on the credit default swaps on Greece, making the premiums going up because there was a large demand. The premiums going up was giving, that would be translated back by, for instance, by the IMF. And there was a bit of a scandal that they would ignore the speculative dimension in that. And Madame Parizeau, at the head of the MEDEF, the bosses trade union in France, was particularly incensed about that. People were speculating on the fall of Greece, trying to make money out of its distress, although they were not exposed. They were doing that just in order to benefit from the credit default swap on Greece. The fact is, what now we're really coming into, I can really raise a proper ethical issue here. It is regarded that currently the market for credit default swap, I say currently, but I shouldn't say that because the most recent figure I found was for 2008. In 2008, the market for CDSs was $62 trillion, 62,000 billion dollars. And when you look at that $62 trillion amount, it is about 10 times the wealth which is existing and could possibly be insured through a credit default swap. And that means that there is something like a 900% part of that market which is just speculative, because people actually insure themselves 10 times for 10 times the amount which is actually there. Now, where does the ethical issue lie here? Which is that when the market for the credit default swaps collapsed, and as said, it involved the main actor who was hit by that was AIG, but there were smaller players who were not necessarily small in terms that they didn't have, let's say, like 10% of the market, and one of them was called AFH, if I remember well. FSA, Financial Security Insurance. And I see some smiles in the audience because people may know that FSA was a major component of Dexia. And Dexia was to some extent brought down by this. But what happened, as you know, is that when all that money needed to be repaid, that the states came in and they tried, and they managed to a large extent to repay all the money that was owed. Belgians know that they have to come up with the money lost by Dexia. The Americans know that they have to come up with the money lost by AIG, which amounted to a total of $180 billion. But when you realize that that money being paid is not necessarily for wealth that's been lost, but it may be, and it actually is, for that 10,000 amount, that 10 time amount of actual wealth. You're being given a bill for 10 times the amount of what actually has been lost. And the 900% more that you're paying is for the bets that were made by people who were simply speculating on these markets, and you're repaying that too. So I would say that to some extent it would be one issue if the taxpayer is asked to pay for some money, some wealth that's been really lost. That would be one thing. But the fact that they're asked to pay in addition to that, another 900%, which is simply for money that's been lost by people who were simple bettors. I don't think there's any justification for that. I don't think that the way I present things here is the way that people necessarily look at it. They seem to believe that the money they're paying as a taxpayer to the financial markets is money for amounts that have been lost because of bad luck. They're not being told that they essentially pay that 90% of what they're paying is just to pay some bettors who were just trying to make money out of without being exposed to any risk. And that's why when I introduced my lecture, I said when we look at things in terms of risk, then probably we'll have an edge in order to look at what is the ethical position to that. If I take, let's say, the sharecropper position as being a sharecropping contract as being a fair contract, because there is a risk, you define, hopefully in equal terms, but anyway, between two parties you define in which way the gains will be shared, but also the loss will be shared. You have a situation which is fair, and nobody else is hit by what you're doing. I mean, there's no external party will have to bail you out, to use the current phrase. You're taking some risk, you're an entrepreneur, you're a landowner, you're doing, I would say, using your full freedom to enter into a contract. Whatever will happen, it's only the two of you being involved, and there won't be any loss for any external party that you will draw into the misery that you've been producing. If I mention here now the credit default swaps in the way that I've done, then you see that you've been betting and you've been repaid for having lost your bet. You're being paid by the taxpayer of some country. I think this is a very blatant case of where there's some ethical issue being involved. And as I said, maybe it's a bit the way I approach a problem, the way I've introduced the whole issue in order to get there, which is a bit unusual because I talk about agriculturalists on the land and landowners and so on, but it ends up putting that picture together of taxpayer paying 10 times the amount they should normally have paid for the losses they incurred. And the figure, I mean, that figure is not made up. I mean, it's a figure that's been calculated by, at maybe 9.5 times, or 11. I wouldn't be surprised. But it's in that order. The bill that's been transmitted to the peoples of countries, of nations, is about 10 times as high as what it should have been without speculation. Let's move now to other type of instruments, which is the, I'll be dealing here with the securitization. What is securitization? And I'll be talking about securitization because the typical security that I want to talk about is the mortgage-backed security, which was backed by prime loans, prime house loans in the United States, and the subprime and the ABS, asset-backed securities, were backed by subprime loans. Asset-backed securities were not backed only by subprime loans. Typically, they would be backed also by car loans. They would also be backed by revolving credit card loans. They would be also backed by student loans. That would be essentially there were also, airplane leases, other things of that type. That would be asset-backed securities, and that is called asset because the term is quite generic. You can put any kind of asset in it. And what is securitization? Well, typically, in order to make a loan liquid, to make it easy to sell a loan to a third party, you would securitize it. You would put typically like 1,000 or 2,000 or 3,000 of small loans together in order for them to become like a large debt instrument that would very much behave, because that would be the template you would use, like a sovereign debt of a nation, like a bond, like an obligation. why do you why do you make a loan more liquid by doing so? Because it's much easier. It's standardized. There's a standardization. I mentioned selling a loan. Okay, I've talked so far only about two parties. Somebody has lent something, money or something else, to another party, and the other one has been the borrower. But the one who has lent the money may need the money back in some way before the end of the contract. So what he or she may want to do is to resell that contract to somebody else. You would go to you've lent, I don't know, 100,000 for somebody to buy a house, but now you need that money. So you go to third party and say, well, I'll lend money to that guy, and he's going to repay me, but only in 2019. And he's paying me, the equivalent of 6%. I want somebody else to take that debt, and you may sell it to another party. Parties will say, okay, well, I'm going to pay you so much because there's so much, the loan is only is like 3 years into its life, so I won't get this in terms of interest, so I will ask you a bit more, and so on. The calculation is being made, and a loan can be sold to a third party. You have the beginning of what's called a secondary market for loans. Loans can be resold and rebought by different people who become the actual person exposed to credit risk, but they receive the interest rate, and they may have bought that loan from the initial party at a discount, and so on. There is a market existing for that. But as I said, when the market was that on individual loans, it was not standardized. Somebody would have received 100,000 euros for buying a house, another 125, and so on. So dealing with these amounts, which financial markets regard as being small, would be not that easy to do. So why not make a big ABS, which will be $10 million? In order to get $10 million, you have to put 3,000 loans together, but that's what people decided to do. They started putting these individual loans, putting them together. You would have to make some calculations because, it's impossible that you issue loans to 3,000 people on the very same day. So you will try, and typically I've been part of that process, you will try to find, you would buy all over the country of the United States people who have had loans being delivered to them, let's say between on the 1st of January and the 15th of January. So you won't have to make too much calculation. These loans are pretty equivalent. They're within a period of 15 days that they were issued. And if they are 30-year loans, well, so in 30-year time, over that same 15 days period, they all have been repaid. And that's what people did. They made mortgage-backed securities from prime loans. What is a prime loan? I referred to that earlier, the FICO score. Americans look at the way you have been repaying, make your payments on something you borrowed, the money you borrowed, or paying your electricity bill, your gas bill, your water bill, and so on, seeing how good you've been, and you're being given a FICO score, which is a score which expresses whether you're the typical type of person who repays money that's been lent to him or her, or a person who doesn't. Subprime, where people wouldn't have a good record at doing that, at repaying money. Prime would be people would be very good at doing it. And so mortgage-backed securities were made, and they were sold as obligations on the market. ABS were made. Usually what people would do, they would put, people usually repay on their car because they need their car to go to work and so on. So they would put on top of that security, they would put the car loans, and they would essentially put the subprime loans as filling, as reserves. The money coming from subprime borrowers, they would not be put at the top, and people would try to give them a AAA rating from the rating agency. But you would need some filling at the bottom, a kind of reserve where you would be able to put money on top. What would you do typically in order to have the reserve? Well, you would put your 3,000 loans in a pot. You would calculate what is the average interest rate which is paid by all these people. let's say it's 7.5, and you would say, okay, I'm going to guarantee to the people who buy that obligation, that security, I'm going to pay them 6.5. And so I have a spread. I have 1% money which will come in. It could be a guarantee for those who don't pay. And I'm going to put some subprime loans at the bottom, and that will be like of a cellar in which I can go get some money if some missing at the top. If some of the people who have borrowed money for their car don't pay, I'm going to take money paid by subprime owners and borrowers, and I'm going to use that to refill at the top. So that's part of the story. You know what happened in February 2007. Suddenly, because the bubble on the residential real estate in the United States was coming to a maximum, the prices were not going up again. I won't get into the details of the story, but the subprime borrowers were people who essentially would try to get money out of refinancing their house because the money would go up, and they would use, typically some of them would use the money they would get from refinancing their loan, they would use to pay their monthly payments. So you were typically in a Ponzi scheme, in a pyramid, because people could only pay their monthly payments by refinancing the house, getting money, drawing money out of the capital that was accruing. So that was, as you know, that was part of the story. Suddenly the subprime loans were not being repaid, and that was part of the story. But if it had only been that wouldn't have been too bad. I mean, why would we in Europe have suffered from that? That was a typical issue between American companies. Why did it spread the way it did? Well, it spread the way it did because of another instrument, which is the Collateralized Debt Obligation, or CDO. And as you will see, it's not the whole story either. What is a CDO? Well, people made constructions out of different parts of these mortgage-backed securities, MBS, and asset-backed securities, ABS. They started making very complex constructions that they call collateralized debt obligation, where typically you would take bits out of these existent ABS, and you would make a new obligation, a new debt instrument out of it. I'll give a very simplified instrument. Okay, let's say that you want to build a CDO which is rated AA. Typically, you would take 150, that's about the number, 150 ABSs or mortgage-backed securities, and you would carve out of them some borrowers that would be equivalent to a AA rating. And you would take 150 of these slices from these different instruments and put them together into a CDO. And the CDO you would not sell like an obligation where you pay, interest every 6 months or so, every year. You would sell your CDO as a short-term debt instrument, typically, let's say, a 3-month debt instrument. And that would have a lot of liquidity on the market, meaning that people would easily buy it from it. You would sell it very easily. There would be people to buy it, and so on. So a large part of the financial 3 months, 1 month short-term capital, not only in the United States, but in the world as such, became backed actually on CDOs. How would you calculate the risk associated to CDO? Okay, think of it, you have 150 slices of different asset-backed securities and mortgage-backed securities. How do you assess the risk of that? Well, you don't, and that's part of the problem we had. You don't, you just trust the rating agencies that when you take a slice which has been rated AA by Standard & Poor's, you just trust that they did the good job. And when you put the whole instrument together with your 150 elements, how do you make sure that you are not simply putting all the risk in the same basket? How do you know that you're not putting all, let's say, elements of subprime or car loans or student loans from the same derelict neighborhood in Detroit, right? Because if that's the case and they close one particular car plant, people can't pay on their credit card, they can't pay on their student loans, they can't pay on their subprime loans, and so on. So you try to diversify. And that was the way that they were trying to assess risk. They say, okay, when you take these 150 elements, get some in Detroit, but get some in San Francisco, get some in New York, and so on. On the, I don't have a word for it, on the naive assumption that a recession doesn't happen of a whole country at the same time. Well, guess what? It happened. It did. There were also calculations between correlations between these different elements, and if they were not correlated in good times, you would assume, of course, that the risk, that's Mr. Markowitz's theory on the diversification of risk by, what's the name of that particular theory? The efficient portfolio theory of Mr. Markowitz. If you diversify, you don't take any risk actually, because the risk of going down of one will be compensated by the chance of the other one going up. This putting into brackets, of course, that it could be a major economic disaster in the whole country. So the market essentially collapsed through the CDOs. Suddenly, the correlation disappeared, because when everything goes wrong, there's a correlation between the price of everything, the price falls, and everything becomes correlated again. But typically, when you make matrices, you make these big tables with your correlation, and you make an overall calculation. Typically, you will have data which cover, let's say, 10 years or 20 years of data. The day the market collapses, let's say you've got 10 years of data, and then in a year, let's say it's 200 business days. So 200, and you have 10 years, you have 2,000 data, okay? So you see that, okay, that the price of a house in Mexico, and in New Mexico, is not related to the price, to the people defaulting on their car in New York State, right? Okay. Now the market collapses. You add one more data. Now you have, now you make your calculation on 2,000 data, and you add a new one for the new day when the market collapses. Will it be reflected in your coefficient correlation? No, because there will just one data of a collapse within 2,000. Before it shows actually in your calculation, you would at least that cover let's say 100 data. So you will already be 3 months in a disaster before your matrix shows that anything has happened in the market. I will finish by the final example. It's one I already mentioned because I talked about it before, but you will see how it makes sense in the perspective that I've been building by telling a story about simple financial instruments, going into the derivatives, going into the more complicated case of the derivatives. I talked about credit default swaps. I just talked about CDOs. And now, what can you do? You can have a CDS on a CDO. And a CDS on a CDO, that's called a synthetic CDO. So a synthetic collateralized debt obligation is a credit default swap on a collateralized debt obligation. And that's where Goldman Sachs and Deutsche Bank and a couple of other banks were taken red-handed, that they were betting on the collapse of the whole system that I've been describing. Because what did they do? They took a CDO and they started creating bets through a CDS. Okay, I've got a CDO. CDO can be, can pay the money or cannot pay the money, and as we saw, the money in cases cannot be paid. But then if you take a credit default swap, that will actually ensure you that whatever money that's lost on the CDO will be paid by the people who've issued the credit default swap. But in the same way, as I said, that the credit default swaps ended up representing 10 times things could be assured, because you can you can insure the car of your neighbor, so you can actually insure yourself against the whole neighborhood. You can actually go to an insurance company and say, I'm insuring myself against a loss on 100 cars in my neighborhood. And anybody else can do the same. And so the whole thing can mushroom. So what did Goldman Sachs, what did Deutsche Bank do, and I explained it some other time. They took some CDOs. They asked a company, Mr. Paulson, who actually is going to escape to a tax haven very soon. He's told that he's going to move to Puerto Rico. They asked Mr. Paulson to create a CDO which would be the worst possible, putting all the elements, not putting subprime car loans, the credit that they know would be paid by people, but putting those that will pretty sure nobody would pay. Why? Because they would themselves bet on the fact that the value would come down. They would buy CDSs from volunteers on these CDOs they had put together themselves, knowing that they had made them the worst possible in order to win by betting that their value would come down, which is why they would buy the CDSs on them. And as I told before, you can do that for whatever amount. You can multiply it by 10. You can take one CDO and get bets for the value which would be 10 times a CDO or 100 times. Doesn't matter. It's the same issue as if you were betting on a horse winning a horse race, and it would be, your bet would be totally independent of what is the actual value of the horse on the market. If you were buying or selling the horse, it has no relationship between the two. And I'm coming to the end of this lecture, and I hope that by building little by little that representation I wanted to, that I've managed to connect in your mind these different types of financial transactions, that it makes sense. Now, what is the relationship between these different derivatives, how they link to each other? At the basis of it all, you have very simple things like selling or borrowing. By putting these elements together, by by sharing the risk, or by selling the risk and buying the risk, you manage to construct a number of different instruments. You can weather that instrument by making it in a particular way, combining different elements. You can get a CDO, and by getting some type of insurance on a CDO, you can get a CDS on a CDO, and you have a synthetic CDO, and you finally, I would say, get the picture of what happened that really made not only the crisis, which were the subprime loans, but how you could make the crisis even much worse than it could have been by betting deliberately on the fall of these subprimes, by trying to find some bettors against you, and you betting on the fact that the whole system will collapse. Now, a final note, of course, when you think of ethics, you need to think of that situation that develops where the incentive for some of the actors on the market is simply to make the market collapse because they're betting on the collapse. This is, and I mentioned it earlier, I mean, another time within that very perspective, this is the exact reverse of Adam Smith's invisible hand. It's just a hand that leads to disaster rather than lending people through their own interest to contribute to the common good. By looking for the special, particular interests here, they're really fighting and they're struggling against the common good, and they may even manage to destroy it. Okay, thank you very much. So if there are a couple minutes for questions, yes?
You have very well described all the evolution coming from this very simple thing to the very complicated one. And illustrated what are the immense damages that those constructions create. We can ask ourselves the question, okay, fine, those guys having invented those complicated products
yes,
were bright intelligences.
yeah,
Those guys having to control the markets
yes,
were very blind,
yes,
uneducated.
yes,
How can we stop that?
yes. Well, I mean, if you look at that whole construction I just mentioned, you see that there's an additional incentive for doing things the worst possible way, which is that the more toxic a type of situation is, the more likely it is that it's been made tax deductible. The worst, the most damaging part of the financial system are tax deductible. You can make an additional benefit. It is fiscally positive to go into that. So the question you have to ask there, who voted for the laws that made the more toxic parts of the system to be tax deductible, that it would be an advantage to do that? When we look at what's going around here, we know the answer to that. The legislator has offered a text that's been written by somebody else, and he's just asked to sign. And because he has no expertise, and people who ask him to sign say, it's very complicated, if I were you, I wouldn't bother, but you know, trust us. And the people who say trust us are the people who should not be trusted. That's all.
Do you see a method that can stop this kind of acting?
Yes. And I'm working hard on it to, when I go to Paris in 2 weeks' time, when I'm asked to testify to the Assemblée Nationale, that I have a good text to propose to them. Whether they can do anything about it, I don't know. But, you know, I mean, they're one of the places where there might be a will to do something about it.
And the question is the will. The real question is the will.
The will, yes, definitely, yeah. Mm-hmm. Anybody else? Yes, please.
I wonder how the information could be so asymmetric between the insurance companies
yes.
and the insurance takers.
Yes.
Because if there was perfect information, the premiums would be higher, and maybe they wouldn't take insurance.
Yes. Well, that's the totally general issue. In any sale. And I refer to it, in any sale, the information is by necessity asymmetric. The seller knows more about the thing he or she sells than the person who's buying it. And that's why we can have a recourse, go to tribunal and say, well, that person knew that the car was not 2,000 kilometers, but it was 200,000. And that's why we need justice, a juridical system around it, because of the absence of a symmetry of information. The symmetry of information is sometimes acknowledged. There is insider trading on the stock exchange, but it is regarded, and at least I know in the United States, that insider trading is very difficult to prove on the commodities markets, because it is regarded as a normal thing that a person who's selling large quantities of oil, of grain, and so on, knows more about what he's selling or she's selling than the person who is going to buy. And if you were simply told by law that you can never operate on the information you have, it would be impossible to sell, because there's no way that information relative to what you're selling should be regarded by you as irrelevant. It is important, but how much is it possible that you're what's the phrase that how much can be assessed the conflict of interest? That's very difficult to say. Because the simple fact that you're trying to make a profit is an element which will determine to some extent a conflict of interest. You're told, okay, the interest of your client is more important than yours. Well, at the end of the day, no way, because you're trying to make a profit. So you're trying to sell it higher. That actually is the cost, and there's no way to deal otherwise. It is the same issue as trying, to install perfect competition. We're trying to install perfect competition, and it's a losing battle, and we know, and it's been centuries that we're losing that battle, but we keep saying that's what we should try to set together. It's perfect competition. So my remark sometimes would be the following: maybe we shouldn't try to strive for perfect competition and find another system that may have more chances to work, because this one has been tested for centuries already in the losing battle. Yes?
What do you think about the total tax on derivatives?
Yes. Well, there's interesting news today in the paper, which is they introduced on the stock exchange in Italy a Tobin tax recently, and I think the market dropped over a short period by 16%. That's interesting because to some extent it shows that, well, that tax will not be 100% now because it will be on 84%, so the tax will get less money. But at the same time, it shows that it may be discouraging transaction which had actually no reason for being there. If you think like the high-frequency trading, where people who start operations cancel about 90 to 95% of the operations, and if the operations as such, I mean, meaning that there's only 5% of the operations that materialize into a proper transaction. If you put a tax on that, of course it will discourage during operations which are simply to be cancelled, because you would think twice about it. But people who've attended my lectures or are familiar with the views I defend in the outside world know that my suggestion, and I mentioned that in particular when I was talking about Laura Adair Turner's view about socially useless financial operations, my view is that like we did before, like we did in the 19th century, if an operation is really obnoxious, it's really damaging for the markets, I think it would be best to consider banning it, prohibiting it, trying to discourage it by tax. If the tax is too small, it won't discourage it at all. It won't make a difference. It may also, my remark was also, if a type of transaction is beneficial, if it's a good thing, why tax it? It would simply introduce an element which is not necessary. If it's good, encourage it. If it's bad, ban it. If it's really bad, don't try just to hit everything. I would say, to some extent, Tobin tax shows a lack of discrimination. It shows that you don't understand what is the real issue. You just say, okay, I'm going to discourage everything, trying to see whether that works or not. The fact that the Italian market stock exchange dropped by 16% in volume in a period of weeks, it might be a good thing, but some aspects are probably negative too, showing that I think if you have a proper theory of how things work, you wouldn't use a blanket tax as an approach to it. You would discriminate what is good and what is bad. And people say, well, often they say, well, that's very complicated. But then I say, no, I mean, look, when people say it's difficult to eliminate speculation, I say, well, look at FASB 133 within that particular accounting standard, which the purpose of which is to tax differentially speculative positions and proper hedging position. The difference between the two is already there. Just change the word taxing 15% by prohibiting, and that will be it, and you will have the prohibition. No, the people understand much better. When financiers say to politicians, oh, this is so complicated, usually it's much simpler than that, and most of them understand perfectly how it works. And as we said earlier, they know how to use it to their advantage. There was one final, yeah?
Another question. Do you think that the present capital ratios are not?
I can't hear you.
Do you think that the present capital ratios are high enough to prevent collapse?
You're talking about what particular, Basel III or? Yes. I've spent a number of years in my career in finance as a model validator, and I do not think that we have the proper tools to assess, to be able to say that by raising, like for take an example, we say, okay, a systemic bank, a bank which can be nicknamed too big to fail. If we say we're going to raise the provisions, the reserve for that bank by 1.5% to 2.5%, I don't think we have the tools to assess these 1.5 or 2.5%. We don't have the tools to do that. The amount of simplification we introduce in our models in order to come up with a figure like 1.5 or 2.5, that amount of simplification destroys the value of the model at all. They are part of these models which where people don't have a clue what to put. The issue is too complicated. There are nonlinear effects in the instrument. There's no way we know how to calculate the risk. So again, I answer the same as to the question I've been asked just before. If an activity is so dangerous that you think you have to raise the rate of reserves, if it's so dangerous, just discourage people from using it altogether. The difficulty we have is that even if it's for only, I would say, 5 years that you can make a lot of money on something, it will not discourage people from doing it, even if there's a lot of loss possible, and especially if you know that the contributor at large will pay for any errors you make, that you will not be discouraged. That's why I'm very skeptical when people are told that they should self-regulate, that they should be their own controller and so on. The incentive for them not to doing the job properly is too high. One more, last one.
Yeah, it's about AIG, because you mentioned the taxpayer situation.
Yes.
And if I do remember what I read in the press, they said that the state has been able to recoup more than they have given to AIG.
Mm.
Now the question is, if that is true,
Yes.
how can we say that the taxpayer has been shocked
Yes.
by that situation?
Yeah. Well, Miss Sheila Bair, she was at the head of FDIC, and she resigned. FDIC, so she was the make insured of the banks in case of collapse. She would be responsible for the equivalent here of the 100,000 euros you would get if your bank goes out of business. She resigned, and she wrote a book, and there were two messages in the book, which was produced a bit of a tremor in the public in the United States. The first message she was sending was that Mr. Timothy Geithner, who was the Treasury Secretary of the Treasury, that all the measures he took were to encourage one single company, was Citigroup. So that was one of her message. And the other message was that all the calculations which showed that the American taxpayer has not lost any money on the rescue of the bailouts of the banks because of the crisis, that all the figures which tells you that some money was made in the process, they're all fixed and they're all rigged and they're all false. That was her second mention in the book. I don't know how true it is, but she was in a very good position to know what is the truth about this. Okay, and a final one.
I wasn't aware that the naked positions, as you talked about, were such important
Yes, yeah.
in the crisis. So insuring against the risk you don't have, why is it that difficult to say that this is not legal?
Yeah.
Why should we be able to pay for a risk we don't have?
Yes.
This,
Yeah, I mean, to prevent that, and on some markets you have to do that. You have to give evidence that you are called what's the word? A négociant in French. That you're commercial. A commercial, you say in American, and a négociant you say in French. Een handelaar, I would say in Dutch, meaning that you're in a position either to really sell something or to buy something. And if you want to take a CDS on a Greek obligation, well, I mean, you should show it. You should be able to show it. I mean, it used to be like that in before, when the regulation was strict on speculation. If you want to go on the futures market, well, you had to show you had something to sell. You had to show that there was something you were protecting, and so on. So it's not difficult to do. The reason why it is allowed, it is because, as you may know, within economic theory, mainstream economic theory, speculation does not exist as a concept. It doesn't exist as a reality. It's something, it's supposed, and that's what they say, it's some view of the public, but that's not the way we look at it as economists or as financiers. When Mr. Blankfein, at the head of Goldman Sachs, was asked to testify, he said, speculation, never heard of it. I'm a market maker. I make people want to buy it from me. Here's the price. They want to sell to me. Here's the price. Speculation doesn't understand what the world means. The reason why these things are allowed is that a speculator is not regarded as somebody special. He's bringing liquidity to the market. By the fact he's there, in addition to other people, he's useful because he's prepared to buy and to sell. I've refuted that argument and giving examples that what is a speculative price, we are not financiers, we're not economic theorists, so we know what a speculative price is a price which is unusually high or possibly unusually low. Speculators bring liquidity. They do bring liquidity by being there at speculative level of prices, which is not useful to any commercial, to any negociant, to any handler, because you can't do any business at that level where the speculator brings the prices. When I give that example another time, when the barrel of oil gets to $143 and in July 2008, it is the Pentagon who has to say, well, stop that game. I mean, we can't build kerosene reserves enough for the US Navy at that particular price. Let's stop that game. They call for a committee. The committee calls the speculators back. The speculators come, they testify, they don't like it, they go home, and the prices drops again from 143. I guess it drops to 42 in a couple of months. There is, in my view, no need for developing these large amounts of betting around it. And as we say, I would say it would be one thing if the taxpayer would have to repay the loss which is in actual wealth. But repaying another 900% to speculators for the losses they incurred, I don't see any reason for that. No. All right. Thank you very much. Thank you.